Hello, Bloke here, and this is an article I'm about to publish today, and this is looking at just what's going on in the news more than anything else. This sorry, even this article, wrong article. So yeah, what I've covered in this article is so I'm looking at just starting off talking about the Cockney Rebel Substack. So that's one I like reading, enjoy reading. It comes out every Friday. This week it didn't come out, so we're looking forward to next Friday. And Mr. Rebel, who writes it, yeah, hope everything's well with you, and look forward to a future article. I've put a link into here. This is my Substack, so theoakbloke.substack.com, and yeah, there's a link there. If you're not signed up, you should sign up, is my advice to you. So I run essentially 18 months ago, I decided, or in fact, it was more than 18 months ago, I decided to just start tracking when people sort of publish these lists of ideas, like, oh, these are the stock market ideas that are going to do brilliantly in the next whatever, these are the ideas of the year for 2025. I just wanted to kind of, like, the thing that I found was that I'd follow some of the ideas, and some of them would work, some of them wouldn't, some of them were good, some of them were bad. And I was like, do you know what? It'd be really good if they actually just sort of said, look, like, these were my ideas. This is how it worked out. These ones worked, these ones didn't. Just do a bit of navel gazing, because, like, none of us can, well, unless you're a wicked witch from the west or something, none of us can predict the future, and therefore, we don't what's they say in Lord of the Rings, even the wisest do not know all ends to the story. I think is Gandalf says that. Anyway, whoever said it, and it's a fictional character anyway. That's the reality, that when people do come up with these lists of ideas, I mean, they're not all going to work. That's the reality of it, that we don't know what's going to happen, what's going to sort of crop up, and cause different companies a problem. So it is a balance of probabilities. It really is, and I kind of realised that. But I kind of said to myself, do you know what? I'd like to pit my own ideas against the best other people's ideas in the country, in the UK. And I've sort of chosen people in 2024, sort of the great and the good, and I've done the same in 2025. And in fact, there was a few readers that said, I'd like to have a crack as well. So, I mean, obviously I can't open the floodgates, and it's enough work to track just even 7 sets of ideas to try and do hundreds. I'd be, it'd be a full-time job or something. I'd probably need to build some software to do that. But yeah, look, I mean, the whole point of it is to kind of just hold sort of a visibility as to what's going on, what's worked, what's not worked. Because I find that sometimes people will speak loudly of their victories, and quietly shelve their failures. Whereas, I've never made any bones about, there was ideas that I had in 2024 that went bust, minus 100%. It happens, or it can happen, and touch wood, it's not happened this year. Far from it. It's been a very successful year, very, very successful year so far. Again, touch wood. But I'm not the leader. So the actual leader in the 2025 Oak Bloke Fun Run, obviously there's no running involved. You're just running ideas for 12 months, a set of stock market ideas. So, it's a metaphorical fun run. But Mr. John, one of the readers, logged another 3.7% gain. So this is his 25 ideas, I think it is. And some of them are weighted more heavily than others, but you can see, like, he's got 4 here that that have more than doubled so far this year. So this is now recorded on the 2nd of August. So we're 7 months into the year. The Works, Thor, Orchard, Secure Trust Bank, and MEFL, Close Sylvania, Georgia Capital are sort of all, they're all above 50% gains as well. I mean, even if it's only four that have more than doubled in price, made a more than 100% return. Even these ones are just spectacular. I mean, look, it's until you get now. I haven't reordered these, so I've used the same chart from the month before, so you can kind of see Pets at Home, for example, is now on a 3.8% gain, whereas last month it was double digits. So it's dropped a lot in the past month, is perhaps what I'm saying there. But yeah, you've got lots and lots that are in double digit gains, and overall he's at 30 something percent. We'll come to the number in a minute, but I've covered the Works today. So I've kind of covered a few things actually. I've kind of looked at obviously we've had the Trump tariffs Mark II coming into effect on the 1st of August, which was yesterday. So these are the countries affected. So these are countries importing or exporting rather to the US, US importing from those countries. And obviously they're chunky tariffs. The tariffs are not on every and all goods. So I think oil and gas, for example, from Canada to the US, there's no tariffs on that, and things like semiconductors and various, there are quite a number of exclusions. A big exclusion to copper, which was meant to be 50%, and now it's copper products. So if you import a copper pipe to the US, it's 50% tariff. If you import copper sheet, which you could roll into a pipe, it's zero tax. So you can sort of see where that's going as well. Now, yesterday there was an announcement from the US in terms of the US jobs pay, non-farms payroll. So the big news there was the revision down from prior months. So last month and the month before, there was basically virtually no job creation. As you can sort of see it here, it's sort of revised down by 84,000, and yeah, that's kind of highly suggestive of imminent recession, or at least it unmasks a rolling recession. So I mean, I've made the point here, like obviously with the effect of Doge, laying off a lot of government workers, it is noticeable in the numbers that there was virtually no growth in government workers in 2025. Surprise, surprise. So yeah, Trump tariffs 1, Trump tariffs 2, and Doge are further explanations. So that's the jobs creation as it stands today, and that was yesterday's number there. So obviously, not sort of, I mean, obviously below its recent times, but not still in expansion. So not altogether a terrible result. And I think I'd also sort of point out that there are other measures like the services PMI for July has increased from 52 to 55. The consumer confidence July has increased from 60 to 61.7. It's not all doom and gloom by any means, and I think this is a very interesting. If you don't know Cathie Wood, I think her coverage of the jobs report is always excellent, really excellent. I've made some notes on some of it here. So from her point of view, there's evidence to show that monetary policy is too tight, that you can look at things like the 2-year yield minus the 3-month yield, and that's in negative territory. And every time that has happened, there has been a recession. So it's overly tight. That yes, there will be, and there is some inflationary pressure, but she sees there being a short blip due to tariffs, but then after that, very strong deflationary forces. Tariffs have already contributed and reduced. So it contributed nearly half a trillion, and has reduced the deficit from 7.3 at the start of the year to 4.7. Again, Wood anticipates a reduction of the US deficit to 3% by the end of next year. Now, if that happens, I mean, they could, by the end of Trump's term, be at or close to a balanced budget. The point being that that all of that would be incredibly positive for US markets. If the US economy is growing, but the budget deficit is not growing or growing very slowly, if economic growth outpaces the government deficit, then the government deficit as a share of economic income drops. And that is incredibly positive. And that's transformative from where they were, 12 months ago. I mean, it's incredibly different. So, or potentially incredibly different. It hasn't happened yet, but it it does appear like there could be some very interesting positives to what's always described as a negative. And obviously it can be negative. I mean, if you're Canada, if you're a Canadian exporter and you're I don't know, 100% of your business is to the US, and all of a sudden now you're going to be faced with 35% tariffs, and yeah, that is a negative, of course it is. There'll be businesses that go bust as a result of those tariffs. There'll be businesses in the US that spring up and thrive because of those tariffs. Maybe that Canadian exporter will relocate to the US because of those tariffs. In fact, it's very highly likely that that sort of thing will go on and happen, which is obviously detrimental to Canada in this example, but positive for the US. So uh, there's of course all of that. I think the other thing that Wood points out is the degree of inward investment. So that is well above a trillion, um, and that's government level, but also individual companies. So the likes of SoftBank, the likes of, well, even just US companies making investment decisions to reshore elements. So Apple, as an example, that historically has done pretty much all of its manufacturing offshore in China. That manufacturing is starting to come home and also go to other and different countries. So there's that inward investment into the US, but also the tax changes. So the ability to fully expense R&D in year one. Now, prior to the big beautiful bill, it was a 5 year. So if you spent a million, let's say, I mean, let's talk. If you spent a billion, you'd be able to offset 200 million of that per 200 million per year for 5 years. So you'd be able to expense 100% of it, but only over a course of 5 years. So you'd still be paying some tax. Whereas 100% expensing in year one, well, there's going to be quite a number of companies that will say, well, look, if we invest into our own business, like we're going to pay no tax. We are essentially able to offset our entire tax bill, which is pretty impressive. I mean, well, I'm not saying that will be widespread, but there will be some where that will be the case, or at least it will be substantially the case. Overall, I mean, the headline rate is 21. Wood reckons that the effective corporate rate because of this R&D will be 12.5. So 12.5 versus 21 is about 40% of the tax burden, corporate tax burden. That is incredibly attractive for economic growth. So, in my opinion, that's the jobs report video. I've included it there. I'd encourage you to watch it if you've not, if you don't know Cathie Wood. Certainly very um, always very intelligent things and backed up with a lot of evidence. So I talk as well about PGMs, and it's been a bit of a pullback. I would certainly say that pullback, in my opinion, is not going to be permanent. If we look at the PGM market, I mean, you can see gold bounced strongly yesterday. Platinum has bounced strongly yesterday. And then if we go down to palladium, no, not so much. But I mean, let's look at this here. Year on year, rhodium is 50% higher than 12 months ago. palladium 37, it's up 35% this year. So this is the year-to-date figure here. So the fact it's down here 3%, this one's only up 0.2. I would not pay that so much attention. I would say the PGM story is alive and well, and this week's pullback is just nerves because of the August the 1st tariffs. I think the pullback in this is Mr. John's idea, Sylvania, or my idea, well, and Mr. John's actually, Theresa. I think both of those are really excellent. I think Theresa's at 88p. I covered it quite recently where I was looking at the economics of it, and it looks incredibly attractive in my opinion. I mean, when you sort of realize that it's not even trading at its own book value, let alone the profit potential of rising PGM prices, and at the end of the day, these PGM prices. I mean, that price there 1,200, and that price there 1,300. You can still buy 2.5 ounces of platinum for 1 ounce of gold, but go and look up how prevalent gold is in the Earth's crust and how prevalent platinum is in the Earth's crust, and platinum is many times more rare. So does it make sense? Does it make sense that there should be this should be at sort of 60% discount to gold? I don't think so. I think there's an arbitrage there where, I mean, if nothing else, this link here takes you to a Mining Daily link where jewelry demand for platinum and possibly palladium and other metals, but platinum particularly, has shot up because, I mean, you could have, well, essentially for the same money, you could have a platinum ring that has 2.5 times more metal. You could have a 9-carat gold ring, or you could have a 24-carat. I don't know if they do 24 carats for platinum, but you get what I mean. That essentially you can get 2.5 times more ring for your money, and like it's a white shiny ring. I mean, come on. White gold, white platinum. I don't know that many people that would be able to tell the two of those two things apart. That's just my opinion. I mean, maybe you can. Maybe you'd be like, I don't know. Of course, you can tell them apart. I don't think you can. I mean, if somebody says, "Oh yeah, look at my wedding ring," it's or even that, look at my wedding ring. Like, oh, that's lovely. What is it? Like I don't know. Like, is that silver? Is that gold? Is that white gold? Is that platinum? I don't know. Is it? Is it chrome? Hopefully not chrome. But anyway, yes. So I've covered the works, and this is well, going back to Mr. Rebel. This is something that he wrote about last week. So very interesting. In fact, I read through his findings. So I think back to it again here. His findings are largely, well, in fact, I think wholly based upon what the RNS itself says. So I think I've still got that here somewhere. Yeah, here we go. So this is the 52-week traded update, and yeah, I mean the bit that I took from it was that there's growing margins, there's growing sales, there's growing, so I kind of went through it, and I was, because obviously when something has gone up by I think it's 175%, that Mr. John, this has gone up by for Mr. John, that when something's gone up by 175% year to date, you probably think like, have I missed the boat here? Have I missed the party? Oh yeah, say there 175%. Like, has the ship sailed? I actually looked at it and was like, well, no, actually, well, depends on whether, of course, they can deliver what they say they intend to deliver. But if they can, and if they do, I mean, and if you've kind of exited the works having sort of rubbed your hands with glee and said, right, goody, goody, I've made 175%, I've more than doubled my money. I mean, obviously, well done to you. But for the next person that buys that share from you, I think there's still plenty of upside. Just to sort of evidence that. So what I did to work that out, to substantiate that statement, because obviously I don't like to just say things for the sake of it, was so this was sort of the FY25 results. So I think FY25 was up to the 4th of May of this year. So they made 287, I mean, million pounds, that is. Their buying costs are 120, or were 120. So everything under here is kind of what Mr. Rebel says in his article. So in his article, he says, well, because the dollar has re-rated, there's 10%. So the buying costs from abroad of 120 million would equate to a 10% savings. So I said, right, okay, well, that's 12 million. He talks about a 15% increase to earnings per share. So I said, right, okay, well, or no, sorry, 15% on PBT, I think was what was said. So I said, okay, fair enough, that's 1.25. That the margin this year was 3.4, but they are aiming for a margin in excess of 6%. So I said, well, in excess of 6% is 7%. Like, I'm not going to go 6.1, I'll go 7. That adds another 10 million to the future margin on the current sales. So what I'm saying is that 287 with an extra, what would that be, 3.6, okay, gets you an extra 10 million of profit, okay. But then because there's also the additional sales. So what they say is that they reckon they can get to sales in excess of 375 million are being targeted. So this year they've got 287. So what they reckon is that they can get in excess. So I've gone with 98 million as the excess. So that would get you to sort of 395. So again, I've just sort of used 20 million more than, in excess means 20 million. Obviously, you can make up your own numbers at this point, and that would deliver that additional EBITDA as well. So adding all those together, I mean, that gets you to 30 million additional EBITDA. And what I've done down here is just apply tax. Now, there is no debt as such, other than that they've obviously leased all their properties, and there's lease liability interest. So I've deducted that, I've deducted tax, and I think that's everything that takes you from EBITDA to net profit. But obviously, what I'm sort of saying to myself here is that these are all just going to be based upon the existing shops. So there's no additional lease liability. There's just sort of, this current 9.5, based upon these assumptions, grows from 9.5 to 39.5. And if that's the case, and obviously there's some tax that comes off that, that gets you to 26.5 million, which gets you to at today's price, that's up 175%. That gets you to a price earnings of 1.4 times, which, because obviously that number there versus 36 million market cap, that's where I'm getting this 1.4 times from. So, I mean, that is just incredibly cheap if they can do all of that. But I suppose that's the bit you've then got to sort of have a think about. And can they? I mean, they have in FY25. They've this profit figure here compared to the year prior. So just sort of show you that. So that's the PBT there, the EBITDA's that one there, look. So they've gone from 6 to 9.5 from one year to the other. So, and maybe the other way to look at this is to say, well, maybe this isn't instantaneous, or isn't sort of FY26 specifically. I do say FY26 plus. So, maybe it takes more than a year to get there, but if it took 2 years to get there, or 3 years to get there, I mean, you're still looking at sort of like potentially 200, 300%. I mean, 300% upside would put that at 5.6 times earnings, which is still dead cheap. At some point somebody would say, well, that business is worth 10 times its earnings. I mean, you look at Greg's at the moment is 12 times its earnings, and it's dropped in price. Now, I'm not saying the works is on a par with Greg's necessarily. Obviously, they're quite different businesses, but they're both high street businesses. And I guess, whilst with Greggs, you've got the sort of, people need to eat, so they'll potentially be eating in Greggs, a couple of times a week or whatever, or you're at the motorway services. Oh yeah, there's a Greggs. It's kind of one of those things that's sort of, you wouldn't necessarily you wouldn't have a rumble in your tummy if you didn't go in the works. you know but you have got that nag factor. I suppose that's the thing. Like, if you're out in town with your kids and you're walking past the works, it's, oh, daddy, can I go in there and get a puzzle? Or it's that nag factor thing that I see all the time with sort of parents, grandparents, and whoever. That oh yeah, let's go in and get you a puzzle or whatever it is. So yeah, I do like this business a lot. Actually, I sort of then make the point down here that I sort of haven't really spent a lot of time looking at retail. But maybe I should. I'm slowly becoming a convert to that vertical. Anyway, I then go on and cover Ecora. So again, this is another of Mr. John's ideas. So I covered it recently in this article here, Ecoraging, which is this one here. And yeah, I mean, I can't remember whether I recorded a video about this, but I suppose the issue here is that historically this was a coal, so this was called Anglo Pacific, and it would essentially be largely coal with a little bit of other bits and pieces, and now they've turned it into a battery metals royalty company. So predominantly copper, with quite a bit of cobalt and some vanadium, some uranium, so obviously you don't make batteries out of uranium, so I'm not saying it's wholly battery metals, but it's sort of new economy metals. The sort of electrification macro, the net zero macro, all of those things where this plays nicely into. And of course, vanadium, uranium, um, cobalt have all been at record lows for the last 12 months, pretty much. I mean, they are sort of bouncing again. If we just quickly cover that, I mean, copper is sort of 10% up year on year. And then we've got then we've got sort of cobalt is, you can see here it's up 37% this year. So what's happened this year is the DRC, which is a major producer of cobalt, and a lot of child miners, and as in miners mining the ground, not miners as in below 18 years of age, but a lot of child labor, a lot of sort of quite questionable production of cobalt. So they are trying to tighten up on that. They have put a moratorium on exports. So they've kind of said, right, we're not going to export cobalt for the next 6 months to let prices recover, which is great. Now, Ecora has a large royalty over a mine in Canada called Voisey's, and that is ramping up. So basically, what we're seeing is we've got like a lot of new things coming online with Ecora. The coal's dropping away, but I think there'll be potentially a period of possibly a year in 2027 when you've got sort of quite low numbers. But I'd say the longer term, like if you are patient and if you are somebody that kind of, like, if you see it as a 5-year investment, I think there'll come a day, in the next 5 years when copper prices are much higher than they are today. Demand for copper demand is outstripping supply. Existing copper mines are dwindling. They if you go and look at I don't know, the likes of Antofagasta, for example. I mean, they're all pulling copper out the ground that are sort of like 0.4 grams per ton, whereas typically with these guys, I mean, these mines here are very, they're very high grade. So I think this one, for example, Moxco, something like certainly sort of like 2%, rather than as I say, the sort of 0.4% for Antofagasta, that kind of thing. So yeah, there's quite a few upsides to that one, I believe. And moving to Greg's, I mean, I wrote about that. I've recorded a video about that, so I'm not going to sort of cover that too much in this video. But yeah, I think the thing that I recorded in the last video that I'll just call out a second time was that in the RNS, they talk about the capital allocation priorities. And one of their allocation priorities is, I think it was number 4 of the 5 allocation priorities, was to say, let's reinvest, but where there's a return on investment of 25%. And I just point out that, when Greggs have poured a billion of, it's not quite a billion, it's I think 0.91 billion to be precise, but when they've poured so much investment back into their business, and that's into supply chain, into their systems, their SAP S3 HANA system, into refurbishing their shops, all of these things have been done. I mean, maybe not at a 25% return on investment hurdle, but certainly it won't be far off that. I mean, and I mean, in my last video, I think on this, I said, well, what if it's 10%, like a 10% return on investment that actually is achieved on 0.91 billion? I mean, that's a 91 million increase to profit. Yeah. So there's going to be an upside to it. Otherwise, they wouldn't have done it. It's as simple as that. But also, it's an enabler to enable 3,500 shops. And the other point I made in that article was to say, like, these people that are saying, oh, it's all getting cannibalized, and like they open a new shop and then like the new shop's just taking like half the sales from the old shop nearby, and like there's no evidence to that. Like, where's the evidence? Greggs themselves say that they're tracking it through their app, and the cannibalization is below 5%, which is pretty much zero. And like, common sense tells you, like, I don't know, if there's a Greggs sort of 5 miles away down in the next town or something like that, you're not going to make a beeline or a point to go there. You might be there sort of, I don't know, visiting a friend, or like, whatever. But if there's a Greggs in your locality, then you'll use it, or potentially use it. Whereas if it's 5 miles away, the chances are, unless you just like driving around, that you're probably not going to be using it, or at least not very often. So this is the other thing. I mean, if you cannibalize it, but rather than them using your shop once every 6 months, because it's when they're visiting that town, they sort of, it becomes once a month. Well, you've just increased your sales by 6 times. And 1/6 of that is the cannibalization, but who cares when you've increased the sales 6 times? It sort of, I think it's a very short-sighted way to look at it, to say, oh well, it's all saturated and cannibalized. I don't think so. I think that there's a lot of locations where there are no Greggs, because I've gone through the store finder and had a look, at different areas of the country. There's virtually none in Northern Ireland. There's large parts of Scotland. I've gone through parts, quite a few parts of England. So I've not done it exhaustively. I'm not that sad, but like, certainly I can see how they could squeeze in another 700 shops, so they've got expansion for the next 5 years. And then, as far as I'm concerned, I mean, there's something about, oh, they tried opening in Belgium. Well, I mean, the Belgians' national dish is mussels in garlic and butter. Like, they're not natural Greggs customers, whereas there are countries like Spain. Like, I know for a fact that the Spanish will visit British cafes and types of shops, because they love their pasties. They love their pies, pasties, sausage rolls. They love that stuff. They'll eat that stuff all day long. And I've got evidence to prove that Greg's expanding to Spain would be a successful expansion. There are other countries as well. I think Belgium's just not a very, it's not the country that I would sort of associate with as the natural one for Greg's. I mean, Republic of Ireland is a natural one. There's loads of brands, UK brands, that have gone over to the Republic of Ireland. That Greg's would be a good fit there. Definitely be a good fit there. But then you've got Germany would be a good fit. Eastern Europe, Poland, good fit. Poland's a very large and growing, fast growing economy. Very good fit. And there'll probably be quite a few million Poles that'll be like, oh yeah, I used to eat at Greg's when I lived in Britain, and because of Brexit, I've come back to Poland to live, but I remember my Greg's fondly, and therefore you would have sort of a few million Poles that would that would be immediate customers, because they sort of like, oh yeah, and then like when you go to the world food aisle, the Poles like their sort of their food tastes are not vastly different to British food tastes, is perhaps what I'm trying to say. Few differences. I mean, we won't go into that particularly, but and then there's other countries as well. I mean, Scandinavia, I think would work well, the format. Holland, I think it would work well. Denmark, well, that's part of Scandinavia, I suppose. But yeah, I think that there's reasons to think that Greg's has a nice rosy future uh, beyond its potential saturation of the UK one day in the distant future. Anyway, moving on to my ideas. So, I mean, I added 9% in July, so I'm delighted, as you can imagine. Quite a few, three double baggers, one triple, or two double baggers, one triple bagger. So Macango has performed amazingly, thanks to Mr. Trump and the Chinese and the rare earths. Energy fuels, not as much, but same theme, same macro that's driving both of those. Kavango, MAFL, I mean, these three are all gold related. Somebody did say to me, like, why didn't you just choose 25 gold miners? Because you would have absolutely wiped the floor of everyone else, and you would have been like the Mr. Triple Bagger or something. But there we go. I mean, like, I wanted to deliberately do a balance and not try and sort of bet on one thing and one possible outcome and then get it wrong. For me, that it was about having a broad balance that would, I called it an all-weather portfolio, and you'll see that I've got sort of quite a few double digits, and then there's 4 or 5 now that are into the negatives. And obviously these two here that are minuses. I mean, that one was disposed of at I think it was 42%, and that one was at minus 8-9%, something like that. Which I mean, it's not gone anywhere since I called time on Water Intelligence, so don't expect it to go anywhere particularly. But if it does, great. I mean, I don't wish it any ill, but I don't think it'll do as well as I mean, I've moved them, for my part. I mean, I sort of see Ondo InsurTech as a far better and a far more visible. I mean, where are the insurers that are standing up in public saying, like, yeah, we love Water Intelligence's water monitoring product? Like, they say that they're working with all these insurers, but where's the public proof of that? I watched a video where Ondo InsurTech, the CEO of Ondo InsurTech, has invited and agreed, for NFU to appear with him. So an NFU, I mean, the guy from NFU was quite careful about what he said. He in terms of endorsing Ondo InsurTech, it was he sort of said it's early days, and there was a bit of guardedness, I suppose, because probably he was under orders not to say certain things, or to be careful, not to do a public endorsement. But yeah, I mean, I'll be writing about the Ondo InsurTech results. I don't know, probably need to stick to what's in this article rather than anything else. So anyway, these are the results for the year to date. So Mr. John at 32, me at 28, Mr. Thompson at 10.1. Now, considering we were neck and neck a month ago, and by the way, these start amounts were just how many ideas you started with. Like, if you wanted to start with 25 ideas and put weights on them, then that's what I decided to do, and that's what Mr. John decided to do. Like these all these other ones are not. Oh, in fact, Mr. Arby's got weighting as well, but all these other ones are just sort of 9 ideas at 1,000 each. So it's not about how much you've made in absolute terms; it's about the percentage. So it's not like just because I've got 35 and they've got 9, it's not that it's unfair. Do you see what I mean? Because it's all about percentages. But yeah, we were both neck and neck, and now we're sort of quite far apart. So I think it's K3 delisting that has sort of not helped Mr. Thompson. Mr. RB is a passive investor, Vanguard, 4 different Vanguards, US index, non-global index, ex-US, bonds, and Bitcoin. His 4 picks, and so essentially, don't worry about reading RNSs and any of that stuff. Like presumably anybody watching this video does daily or periodically, or at least you sort of watch somebody like me that talks about these things, so you don't have to read RNSs. But Mr. Arby doesn't read anything. He reads, I don't know, Robinson Crusoe or something, and drinks a beer and doesn't worry about the stock market because he just invests in a passive investment. And for 2 years running, that has worked really well for him. I mean, and he is in the race to sort of say to all these active stock pickers, like, half the time you're just wasting your time. So just chill, just go and put it put it on put it on an index, put it on a passive index, maybe on several, like that's part of what he said as well, like some of it on bonds. So it's not quite 40/60. I think he's got 35 on bonds and 5 on Bitcoin, and then 60 on, well, I think it's 40 on the US and 20 on the global non-US, something like that. So it's yeah, it's a spread across 4 different, but works well. I mean, he's made 9% this year, not had to worry about it, and he made, I think it was about 7.5 or 8% last year. So, you know, like it just goes to show that sometimes, poring over, annual reports and RNSs, you've got to question, like, is it worth it? Can I just make the same money or more by just doing nothing? you know like that's an interesting, I do like that. For me, that's a sanity check. So Mr. Head down 6.8, Mr. Hill down 10.4, and Mr. Madone down 47, and that's Touchstone, single pick. And it's not had a couple of fundraisers this year and different things like that. Going back to last year's results, so over 18 months, or sorry, 19 months even, Mr. Scott's still leading, 16.8, but my ideas from last year are now sort of within touching distance. I'm waiting for the day that they catch up so I can sort of have a little post 12-month victory of my own. But no, joking aside, I mean, it's just interesting to see, like, are these long-term ideas, or have they were they just an idea for a season? And obviously it's just some different results. I mean, it was interesting if you take the average of all the ideas of this year, because obviously some have gained, some have lost, and I've done equal weighting for these. Overall, we would have, between us all, would have gained 2.27%, whereas last year on average, following everyone's ideas, would have lost 6.4%, even though there were some gainers, and that's based on the current numbers. Mr. Scott was at about 32%, I think, at December 31st. And obviously this year, his ideas from last year have dropped by about 15%. So it's and I think I say that down here where I'll come on to that. So anyway, I suppose I sort of talk a little bit about the ideas that worked well, the ones that didn't for me. That as I say, I don't hide anything that went badly. I mean, I'd rather sort of just learn from it. And you, like I say right at the start of the video, I mean, you're not mind readers, you're not sort of fortune tellers. And companies run out of cash. This one did. This one's sort of suspended at the moment, but I called time on it a couple of months ago, and that seems to have been the right thing to do. Much as I didn't want to, because I wanted it to succeed, but I said, you know what? Like, even though it's at, so I think it was at 91% loss, so there wasn't much money left, you know, of an imaginary £1,000 uh, down to the last £90. But I thought, you know what? I'd rather just call time on it and sort of recover 9%. Sometimes you just got to do that, even though you're at a whacking loss. It can be sort of psychologically, you can sort of say, oh, I've got to win back my 91% that I've lost. But sometimes you could say, well, do you know what? If I put that £90 on the works, and if the works can quadruple from here, I mean, obviously £90 has only become £360, but at least it's making you money rather than, you know, potentially if you just hang on grimly till the end. I mean, I don't know what will happen with Bellascura, but I mean, essentially they're looking for funding. If they can't find funding, then I guess they will, you know, then it'll be a minus 100. Yeah, and then a few people said like, "Oh, you know, why are you calling time at this late stage? Like, you know, surely there's a chance that it could recover." I said, "Yeah, there's a chance, but I'm just now of a mind where I'd rather just cut my losses, reinvest it into something else because I've got other ideas, good ideas, or at least I think good ideas that are you know, where I can make upside." So, you know, I think that's one of the things that I've been very conscious of doing this year is like, don't nurse my losses, cut them, get rid of them, just call time on them, you know. And equally, where like with Nubdug, I sort of said to myself, well, there's still potentially a bit of upside, but I think I'd made 41%, which like, and some of that 41% was like almost like the day, because I released the idea and then I was like, you know, if you invest in this by next Monday. I think it. I can't remember the exact, but it was like the Thursday before, and like, oh yeah, the next Monday is the cutoff date, and they're doing a capital return, so you get about 15% of your money back. Like, I sort of worked it out, and I was like, well, okay, so 15% is going to come back anyway, so it's only costing me a net. However much it was, it might have been like, I think it had dropped down to about 26p or something. So, you know, once I take that 15% out, then it's only like less than 20p, and the NAV is about 50p. So I've only got to, like, the NAV could drop 60% and I'd still break even. I was looking at it, I was like, well, like, I mean, they're a bit circumspect as to what these assets are and all the rest of it, but it's a reputable firm. You know, it's a professional firm that manage assets. You know, NB, which is I'm going to probably butcher the name by trying to pronounce it, Neuberger Berman, I think it's called. That I thought, well, it looks like there's a reasonable chance, and you know, the fund manager had said there's a chance that it will realize at 93% of its NAV, and there's a chance it will realize at 125% of its NAV based upon what we know now. And also the other upside was that they said no, this asset is due to close in early 2025. This one's due to close by mid 2025. You know, this one's due to be sort of later in 2025. I thought, well, again, you know, like, if that asset closes in early 2025, well, that's another X percent of the money. So anyway, I sort of worked it all through, and I was like, well, like, yeah, I'd have to have incredible bad luck for that not to just at least break even, if not. But it made 41%, and I thought, you know what, I'm happy to take the 41%. Chance that I'd get another 10%, 20%, maybe even, like, if I hanged on. But equally, like, it's 41% bird in the hand. Anyway, that was sort of that, and I talk about DGI9 a little bit there, and just sort of, you know, once again, sort of, you know, it's not new things that I'm saying, but when you read across to Cordiance, when you read across to you, that Arqiva are doing all the right things, and you know, this has bounced from 7.5p to 9.8p, so it is like, it's down a lot of percent, but it's actually up 30% from its low. and seems to be quite sort of steady now at 9.8p pending further news. But they've realised some of their assets. I think there's a question mark over, what will happen with the Iceland the cash that's owed from its agreement to get sort of based upon the achievement of profit at the end of 2026. So that's only 18 months away, and that's potentially worth I think it's 110 million dollars, pounds. But there's, again, it's quite difficult to see that there'll be downside on this idea now. There are some complications, and of course there is this whole thing about will the BBC be demolished or become sort of hollowed out? Will the TV license be cancelled? Will broadcast telly be cancelled, or curtailed? What will happen with the new um, post 2029, I think it is, or post 2031, I think it is. Yeah, like that's the theoretical end of broadcast telly as we know it today. But I just think, like, well, no, there's millions and millions and millions of like elderly people who aren't digitally, sort of enabled and not wanting to be. Like, I know plenty of elderly people that oh, computers, like, oh, no, thanks, not for me. And what do? Do you just cut off their telly? Like, those are millions and millions of voters for a start. So politically, like, will that happen? I just don't think it will. I mean, I know people do watch less linear telly than they used to. I watch less linear telly than I used to, but I still watch it. And I think a lot of people still do watch it. So I don't think it's for the bin quite yet, and therefore Arqiva's sort of very, very dramatic markdown in valuation is quite unjustified. I then go on and write about some other things. So the UK in a mess. Well, it's interesting if you look at and I, this isn't a political blog. I've got no interest in getting into any kind of politics with anybody. Not interested. Go and talk to somebody else about that. I'm not interested. But what I would say is that there's always a continual stream of like Rachel from accounts, and I'm guilty of it. I've said it, and I know a lot of people I read say it, but actually read her Mansion House speech. It's an interesting thing to read, and it's interesting that there isn't a wholesale rejection of Rachel Reeves as a credible chancellor by the City of London. There are voices that say actually what she's trying to do is very good. And as I say, read that speech, because she's if she executes what she's planning to execute, that will be incredibly positive for UK shareholders and for the UK stock market. And of course, I think we all agree that things like Ecora, just that I was talking about earlier, or Greg's, or a lot of the ideas, there is that sort of UK discount, and you can evidence that by I know Paul Scott said there are 4 takeovers this week. I don't track how many takeovers there are each week, but there was 4 this week, apparently, according to his I think podcast, and that's in 1 week. So that's like one a day, one company, one listed company per day, almost. Maybe have a day off on Fridays, but 4 days a week, a listed company is getting taken out because they're trading at a discount because they are cheap. you know and if there are reforms to that are being made and going to be made that makes London a more attractive place, a lot of that discount will disappear. I think the reforms where allowing listings in euros and dollars, allowing relaxing some of the rules and compliance rules. There's a lot of things. The Pisces program to allow private equity to list. I mean, that in itself is a fascinating area if they can pull that off. Obviously, there are considerations there. Like what makes a private asset if it's publicly listed. It's private, but it's not really private because it's actually now public. but not public as in LSE, London Stock Exchange public. It's Pisces public. So it's an interesting area, but I think we get caught up in the UK is a mess thing a little bit too much. And maybe what you also need to think about is, well, what if? And and I don't like, I'm not pro Labour, but not at all. But I just sort of look at it as an investor rather than as a voter, or look at it from an investment prism, not from a political prism. The claim that she wants to reduce red tape. I mean, that in itself is laudable. That's good. That's good for investment. That's good for companies. It's interesting that the evidence is that 120 billion of investment did come to the UK. Now, uh, how much of that was just takeovers? I don't know. Probably quite a lot of it, but that is still inward investment. That is still inward investment. These are the numbers from the ONS. So I just sort of, when I see these things, it makes me go off and like, well, what's the proof of that? And the proof is that business investment. So the blue line is public investment, as in that's total investment by the public sector and the private sector. So that is barely increasing or increasing slowly. Private investment has shot up over the last few years, and it happened before Labour came to power, to be fair as well, but it is accelerating far above and beyond what the public sector investment is. And of course, Rachel Reeves is investing. I think her program, coincidentally, of public investment is also 120 billion. So we are going to see the blue line go up, but we can see that the whatever color khaki line is also going up as well. And I mean, yes, like you can blame employers NI and but actually, when you look at other countries and how much employers NI or the equivalent that they charge, it's not vastly different. In fact, some of them are far higher than 15%. So I don't think the 15% employers NI, whilst it's painful, whilst it is a headwind, like it's not going to make the UK suddenly fall off a cliff. I think we lose sight of these things a little bit. I mean, yes, it will have an impact on business profitability. It'll have an impact on inflation. It'll have an impact on different things. Yeah, and UK energy, and I've said this before, but UK energy, I know people sort of focus on this idea that our energy is uncompetitively priced. Well, yeah, it's broadly comparable to most of Europe. I mean, there's apart from countries like Spain and a few others where they have extensive solar and yeah, they have very sunny weather, Mediterranean weather. So they have periods of time with very very low electricity prices. France, over many decades, invested many billions or even trillions into nuclear power. They've got low energy costs because of that. There are specific reasons why certain countries in Europe have got lower prices, and then there's a specific reason that the US has got lower energy prices because they've got abundant natural gas. I saw that Trump said that there's abundant natural gas in the North Sea and abundant oil. I don't think that's true. I mean, from the evidence I've read, the if you could turn all of the contingent gas and oil into proven, like which obviously is not necessarily the case because obviously contingent might not be economically recoverable. Normally you lose about 50, maybe more percent of what's contingent becomes proven reserves, and maybe more than like or less than 50% of it ends up being proven. But let's say even 100% of the contingent. I mean, I read that it would, and if we sort of said, stick the finger up to LNG imports, like, oh no, we're not going to have any of that anymore. It's the same to Norway. Don't need any of your gas. We're going to just have our North Sea gas and oil. We would exhaust it in 5 years. There's 5 years worth of UK demand in the North Sea if 100% of it, or 100% of the contingent is accessible. So So this magic porridge pot of energy that we could be taking advantage of doesn't exist as far as I can see, unless there are new and unproven, not even contingent, but just undiscovered oil somewhere else in the North Sea, or maybe in the Irish Sea, or maybe in the North Atlantic Ocean. The problem with the North Atlantic Ocean is that it gets deep very, very quickly. So we would be talking about going down several kilometers potentially to get the oil, which isn't that easy to do. It's not that cheap to do. The North Sea is relatively shallow and therefore easier to extract. Again, there's no sort of necessarily no easy panacea to these things, and the onshore fracking, I think there's potential maybe for some, but again, not like nothing to the extent that there is in the US, just because we don't have the geological abundance that they have. We don't have a Permian basin that's being denied to us. Anyway, this video is going on a long time, so I'm going to speed up because I'm conscious that there's a lot more to cover. In fact, I'll probably just end it there more or less. But I talk about gold in this article. I talk about Altin gold, Greatland gold. I talk about I talk about the lack of inevitability that gold will remain at high prices forever. I'm forever just looking over my shoulder to say, like, what's going to happen to gold? What's going to happen to gold? Like this week, it dropped below 3,300. I think there will come a time when I mean, obviously it's bounced, but this week it did drop. It dropped to a low of 3,240. Now it's still obviously very, very profitable. I mean, there's nothing like that. That wouldn't be a reason for me to at 3,200. But I don't feel, personally, I don't feel that we're just going to sort of, this hockey stick's just going to carry on forever. And I was just contrasting that with what Bitcoin people believe, that like, yes, it's a one-way street, it's a hockey street. There shall never be a Bitcoin winter ever again. I just worry about those people that believe those sorts of things, because I'm constantly just like, is this macro carrying on? Like, is this gravy train of gold going to end? And I conclude each time, well, no, actually, there's still a lot of money out there washing around, swashing around. There's still the BRICS nations accumulating gold. There's lots of reasons why gold remains and going to remain in demand. The indebtedness of certain countries. There's various reasons that will support gold going forwards. I do talk about it's not my favorite topic, but Anglo-Asian. I do a comparison of that versus Central Asian metals against Jubilee and against Greatland gold. And what I do is I just say, right, well, based upon what they say that they can produce in 2025, 2026, 2027, those are the market caps. Obviously, Greatland gold being the monster market cap. These are all sort of pretty, they're sort of pretty similar. What I do is I take the net profit, but then I thought, well, if I start going by net profit, obviously, here AAZ lost money in 2024. So I mean, it's not fair to go by profit. Let's just go by revenue. So let's take that, multiply out the revenue, like how many gold equivalent ounces. What I then do is I take strip out the cash, so that's the market cap less the cash, and then I take 110 plus 45 is 265. Divide 221 by 265 gets me to £834. So for every gold equivalent ounce that company says that they're going to generate in this year, next year, and the year after, you're effectively paying £834 for each gold equivalent ounce, okay, over 3 years. So in other words, Jubilee, if they can ramp up, and this is basically getting Sable online, getting Rowan working at full capacity, getting the waste rock project going. That will get them to about 27,000 tons of copper, which is, and I'm using a 3-for-1 ratio, 81,000 GEOs. But I don't sort of set any particular expectations for next year. And this number is obviously buoyed up by its chrome number in 2025, and obviously the sale of the chrome business won't happen now until probably September. I think I only take 6 months of chrome and PGMs to include into this number, and I ignore these numbers. But anyway, when I sort of run all these numbers, I sort of conclude and I find, well, hang on a minute. This is not vastly different. Obviously, it's slightly less, but then this is a proven producer of copper and therefore of gold equivalent ounces. Consistently producing 70,000 will, in all likelihood, continue to produce 70,000, and that's zinc, lead, and I'm doing gold equivalent ounces for all of those at the current market price. You're paying £1,000, but the profit margin on the copper element particularly is 63%. So, I mean, this is an unproven amount of profit. I don't think anybody really knows what profit they can make, if any. So yeah, I just sort of look at this, and as a sanity check, I mean, they're all sort of much of a muchness. Obviously, this one's the most expensive, but then what I'm doing here is I'm taking like the current year's Telfer as next year, the Telfer as the same in 2027, despite them obviously investing hundreds of millions into growing Telfer. I'm sort of just using their guidance for this year, next year, and then just using the next year guidance for the year after, and then adding Javier on at the half year, so halfway through 2027, to get that 402,000. So the run rate in 2028 would obviously be much higher again. But I mean, the Javier on is at an AISC of about 700 US dollars per ounce. So the profit margin will be about 2,600 per ounce per GEO. So I think you're paying more, but then the profit margin is going to be so much higher. And this is Australia, so obviously a safe jurisdiction. So there's just reasons why that should be priced higher than that. So I can kind of conclude, well, obviously if they can pull it off and produce these quantities, and if they can do so profitably, then yes, they deserve to be at the price they are today at 210 million market cap. If they don't produce those quantities, or if they don't produce as profitably as these other three can and are already, then I still say Anglo is a risky. Um, you're paying for something where you just don't know what the return is going to be. And even if they can produce the volume, it's also about at what price, at what cost, and therefore at what profit margin. So I talk about that, talk about Ocean Wilson's a little bit, talk about ECR. There's some interesting thoughts there, I guess. Well, you could be the judge of that. And yeah, as I say, there's a few other things that I'm going to talk about. I don't talk about in this article, but Gore Street, talk about Cadence a little bit, and finally about banking. And just somebody asked me this week, like, do you invest in any of the banks? And I said, well, only in the challenger banks, and only those through the investment trusts that hold them. So I was just sort of thinking about that, and then I think it was a day later that Chrysalis announced that their NAV had grown by 10% due to Starling's marvelous performance, which I'd already read about. So I kind of knew that was going to happen, and I've seen similar knockout performances at INOV and AUGM and Tide and Zopa, and all of these are doing really good. Some really good stuff as well. So yeah, that's my take on banking. But I do sort of acknowledge here that going back to Mr. John, that his picks are the two of the double baggers. So as much as I sort of say, oh, I think Augmentum FinTech, for example, is a great way to invest into banking, that hasn't yet double bagged. I I mean, you can buy Augmentum at 92p at the moment, and the NAV is about £1, £1.56, I think it is. So it's you know, like at the end of the day, I've not my ideas haven't. Well, in fact, Chrysalis has double bagged. You could have bought that at 56p last year, and in fact I did, and it's now at £1.20 something, and like £1.20 something is still very, very cheap. I mean, when you consider it's got Klarna, Starling, Smart Pension, like, I mean, you can go and read my articles about Chrysalis. I think there's still plenty of upside. I'm surprised there's a discount, to be fair, but that's just yeah. So but not all of them have double bagged. I mean, INOV, I guess, has double bagged in the sense that I was buying that at 9.8p. I think was my first article on it, and recently was tendered. At NAV, which was 21.2p, so that's more than a double bag for the percentage that I could tender. But the remainder now, I mean, I've got a good chunk of it still for INOV. I think there's still more to come. There's obviously all the upsides that are not in the NAV price as well. So I reckon, and I've written about it, where I think the true NAV is somewhere around 33p, and that's due to Revolut. That's due to the various biotech holdings that they sold off, but then they had sort of agreements for follow-on earnings, potential upsides, earnings, that kind of thing. So yeah, we'll see. I mean, these things are a long-term thing, but as I say, multitude of thoughts. I'll be releasing this article later on. Hope it's an enjoyable read, and thank you for watching this rather long video. I hope that's been useful as well. If you like it down there and subscribe, and really appreciate your support. It's the Bloke signing off. Cheerio for now. Cheerio.